Hi. In this video, we are going to look at Indian GAAP. Indian GAAP means Statement of Generally Accepted Accounting Practices, which is recommended by the Institute of Chartered Accountant of India. Now, we'll see in detail. See, accountancy is often referred to as an art of recording, classifying, summarizing financial information. As is the case with any form of art, accountancy also involves the use of one's creative skills to maintain a record of financial transactions. However, if free rein is given on the system of accountancy to be followed, there will be no limit on the scope of manipulation of accounts. In an environment where the financial statements are presented to external stakeholders such as investors, bankers, stock exchanges, revenue departments, government, etc., there arises a need for an accounting framework on the basis of which the financial transaction should be recorded as to make the resulting financial statements comparable. The need led to the framing of the generally accounting accepted accounting principles. GAAP are the basics accounting principles and guidelines. Well, these are the basic accounting principles which provides a framework for more detailed and comprehensive accounting. The more comprehensive accounting rules, standards, and other industry-specific accounting practices. For example, the Financial Accounting Standard Board (FASB) uses these principles as a base to frame their own accounting standards. Thus, GAAP encompasses. The GAAP encompasses, that is, it includes basic accounting principles, accounting standards usually issued by the premier accounting body of the country, industry-specific accounting practices to cover unusual scenarios. In India, financial statements are prepared on the basis of accounting standards issued by the Institute of Chartered Accountant of India, and the law laid down the respective applicable acts. For example, Schedule 3 to Companies Act 2013 should be compulsorily followed by all companies. The ICAI also releases guidance notes from time to time on various topics to help in the accounting process and to provide clarity. While the basic accounting principles may not directly form part of the accounting standards and the related laws, they are assumed and expected to be universally followed. Generally accepted accounting principles. The following are the general accounting principles as mentioned earlier. Business entity assumptions. It states that every business entity should be treated as an entity that is separate from its owner. Owner is different from the company. So therefore, all the financial transactions should also be distinguished in such a manner. This concept is especially important while recording financial transactions of a sole proprietor. When the entire business with its assets and liabilities belong to the proprietor, the financial transactions need to be distinguished between those related to the business and those related to the proprietor personally. Then monetary unit assumptions. All the financial transactions of a business should be capable of being expressed in a monetary terms. Say, for example, Indian rupees, US dollar, etc. If it is not possible to do so, then it should not be recorded in the books of accounts of the business. Then accounting period. Next principle is accounting period. This principle entails the accounting process of a business should be completed within a certain time period, which is usually a financial year or a calendar year. Thus, every transactions which relates to a particular accounting period will form a part of the financial statements prepared for that period. Historical cost concept. As a general rule, when certain economic resources or assets are acquired by an enterprise, or they are recorded as per cash or cash equivalent actually spent to acquire that resource or an asset on the transaction date. Even if the transaction happened the previous day or 10 years ago, this would result in the value of remaining asset constant irrespective of the accounting period. The market value of the asset is not taken into account unless specifically required by law or an accounting standard. Going concern assumption. The business entity is assumed to be a going concern. It will continue to operate for an indefinite amount of time. This assumption is important because if the business entity were to liquidate in the near future, it would have to restate its assets and liabilities in the accordance with the actual amount that could be realized or payable as the case may be, so as to reflect the true financial position of the entity. Full disclosure principle. An accounting entry may not be independently be able to provide all the relevant information related to the transactions. Hence, the full disclosures principle requires the entity to disclose all the financial information relevant to the investor's user to assist him in decision making. Matching concept. This concept requires the revenue for a particular period to be matched when its corresponding expenditure so as to show the true profit for the period. Accrual basis concept. This principle requires all revenues and expenditures to be recorded in the period it is actually incurred and not when cash or cash equivalent has been received or spent. The earnings of the income and the incurring of the expenditure is important irrespective of the corresponding cash flow. Then consistency. An entity may decide to follow a particular accounting procedure in relation to a series of transactions. Such accounting procedures need to be followed consistently over the following accounting periods so as to facilitate comparison of the result between two periods. For example, an entity might choose to adopt straight line method of depreciation of its tangible fixed assets. This method needs to be consistently followed even in the coming years. It's consistently. Then materiality. Accounting principles allows an entity to disregard another accounting principles if the result of the same does not affect the decisions making of the user of the financial statements. Certain error or omissions may also be ignored if their effect is immaterial to the financial statements. For example, when a fixed asset is purchased, the matching concept requires the entity to recognize the expenditure over the useful life of the asset. If an entity purchases a keyboard for rupees 300 and the turnover of such entity is in crores of rupees, it will be immaterial to the user of financial statements whether such an asset is recognized as an asset or expenses. Thus, even if the computer keyboard is considered as an expenses in the year of purchase, it would not be violating the basic accounting principles since the amount involved and the impact of the same is immaterial. Conservatism. The process of accounting, one might come across various situations where there are two equally acceptable ways of accounting for a particular transactions. One might even have to choose between recording a transactions or not recording the same. In such situations, a conservative approach should be followed. Thank you.